While the US is no longer number one for some big stock investors, to some investors, the US exceptionalism that's fueled the record-breaking rally on Wall Street has run its course. Despite resilient consumption and artificial intelligence optimism, US economic growth slid to an almost two-year low last quarter while inflation stayed high. Confidence is starting to waver, with the S&P 500 index ending a 5-month winning streak in April following a series of major earnings misses. Now, these are signs that playbooks found on expectations that the world's number one economy and its confidence will outdo others even with higher rates are flawed, according to contrarians, including Pictet Asset Management and Amundi SA. Now, instead, there are better opportunities in Europe and Asia, given more benign valuations and inflation outlooks, they said. U.S. exceptionalism is overrated, said Luca Paolini, chief strategist at Pictet. There's probably too much optimism about the U.S. in terms of growth and too much pessimism about the rest of the world. The argument put forward to reflect the nagging concerns some investors have about the toll that higher for longer U.S. interest rate would yet take on growth and corporate health, while balancing that against the advantage enjoyed by dollar-based assets when the world's reserve currency is beating all comers. Paolini, a voting member on Pictet's investment committee, said the Swiss asset manager has been reallocating money away from the U.S. to Europe in the past few weeks. It sees value in domestically oriented sectors such as consumer goods and banks, as well as UK stocks due to its exposure to commodities, he added. Now, growth is rebounding in Europe, while there are indications that the European Central Bank and the Bank of England may ease policy before the Federal Reserve. A survey by Bank of America Corp last month showed global fund managers had the biggest overweight positions on European equities since February 2022. JP Morgan Chase & Co. analysts said late last month that more attractive valuations may drive an improving risk-reward ratio for Eurozone shares relative to the US. In an early sign of such a sentiment shift, the S&P 500 has been lagging its key European and Asian counterparts since the end of March, after mostly outperforming them in the past 5 quarters. Monica Dufan, head of Amundi Investment Institute, said Europe's largest asset manager is underweight the US in its global equity portfolio. Now, the firm, which manages more than $2.1 trillion, is overweight UK stocks and neutral on Europe. US tech is overvalued, and you don't want to be exposed to consumer-oriented sector at the time of an economic slowdown, Dufan said. The disinflation story is much more credible in Europe than in the US. Asia rising. Other asset managers are also making adjustments. T. Rowe prices amped up its Asian equity investment this year while holding large positions in the US. Asia's dollar-based exporters and countries with strong domestic growth stories are likely to outperform amid uncertainty about the U.S. economy, said Raul Ghosh, global equity portfolio specialist at the firm, which manages about $1.5 trillion. Some of T. Rowe's concentrated strategies have been increasing exposure to financial and tech stocks in Indonesia and South Korea, while diversified funds are adding to Chinese equity positions this year, Ghosh said. Now, while the delay in Fed rate cuts puts pressure on Asian central banks and foreign inflows, regional economies are supported by relatively low levels of inflation. Valuations also work in Asia's favor. The MSCI Asia Pacific Index is trading at about 14 times forward earnings, similar to Euro's benchmark, while the S&P 500 is at a near 21 times multiple. Hong Kong stocks have been a prominent beneficiary of global funds' search for cheaper alternatives, delivering a world-beating rally in recent weeks. India, one of the few major markets that advanced last month, continues to trade near record high levels as the economy gets support from infrastructure spending and domestic demand. Asia has historically tended to outperform the US during the Fed easing cycle. Reshma Ong, head of multi-asset investment solutions on the Southeast Asia at Aberdeen PLC, said on Bloomberg TV. The asset manager prefers India, China, and Korea and Taiwan. Meanwhile, Pictet and Amundi are among investors that are overweight Japan, where weak yen helps exporters and rising consumer prices aid local manufacturers. Investor positioning looks crowded in U.S. equities, especially growth stocks with the technology theme, said John Stopford, head of multi-asset income at 91. We have no intentions currently to add to U.S. stocks at the expense of Asia.